Hello, I'm going to talk about three important investment strategies that I found that are really helpful for me to come back and look at, and the things that have helped me the most when it comes to investing. Now, I want to give them to you real quick, but I do want to dive into them. So if you want to stick around and you want to actually hear more detail of how I implement some of these strategies, then go ahead and stick around a little bit longer than the quick video clipper. But if you guys are just out here just to get a quick clip and find out what it is that I believe is really important, that's not talked about as much as it should be when it comes to investing, then here they are real quick. The first one is you always want to invest with an asymmetrical return strategy. And this sounds real easy, but it's not quite as easy as it sounds because these investments aren't the ones that are marketed to you commercially. Now, investment strategy number 2, don't be all in. This is the biggest mistake of rookie and somewhat seasoned investors and guys that start to get cocky. They go all in because they're smarter than everybody else, or they have a win or 2 wins in a particular asset class, and they start thinking, you know what? Not only do I know what I'm doing, but why would I be so stupid to earn 2 or 3% on this account over here when I can make 10, 15, 30%, and sometimes only in 6 months? So I'm going to take all the money from this non-performing asset and throw it over here, and I'm going to outperform myself because a lot of times we're competing with ourselves, our previous performance. So if we had half of our assets in a CD, half of our assets in the stock market last year, then we say, well, obviously I'm going to outperform myself because next year the market's going to go up another 30%, and I'm going to take 100% of my assets and put it in there, and then wow, I'm going to be so much more further ahead. So tip number 2, don't be all in. Now, tip number 3 is somewhat similar to number 2, but it is different. This is don't parlay all your winnings. This can be used by any type of investor that knows the outcome and has done their research, all the way down to the pure speculator that is showing up on the craps table near you and ready to just throw those dice and see what happens. Either way, you don't want to parlay all of your wins because the investor doesn't catch on to this strategy nearly as fast as the gambler does, but you always have to have some in what I like to deem the keeper zone. And it goes in that spot because you need something to pull you out of those big ruts. And nobody knows that more than a gambler. A gambler truly understands investing from that standpoint, a seasoned gambler, because they go through these cycles that we go through in life when it comes to investments and particular assets getting really hot and then going sour really quick, or markets being really hot, or just anytime you think of something right now that would be like Bitcoin, Ethereum, any of these cryptocurrencies, super hot. I mean, they've just exploded. But the true gambler that learns from their experience realizes one thing, that they always have to have some money to make it to the next day or to the next table. If you go all in, then you're all out. So that's the third one. Don't parlay all your winnings from a particular investment. Now, I'm going to go into more detail on these 3 and kind of talk them out a little bit. So if you were here just for the quick cliff notes, those were the 3 things that I find the most important. Invest with an asymmetrical return strategy. 2, don't be all in. And 3, don't parlay all your wins from each particular investment or group of investments that you like to group together in your portfolio. All right, I'll talk to you guys later. If you're taking off, you're going to stick around, then I'm going to go into detail a little bit more. All right, for you guys that want to stick around, asymmetrical investing. This is really important when it comes to investing in things that you know or you don't know, because when you're investing with an asymmetrical return strategy, even when you're a rookie investor, or let's say you're a great investor and you have tons of experience, but you're going into a new sector, something you don't know much about, but you obviously want to diversify a little bit in some of the places you're getting your cash flow from, or some other type of real estate versus the real estate you're doing. It can be any type of, every investor wants to kind of learn a little bit more about other investments. So even your typical like stockbroker, they're going to want to know a little bit more about futures and a little bit more about options and a little bit more of ways to leverage some of the things they have in their portfolio. So anytime we do those, well, guess what we're doing? We can do all the research we want, but at the same time, we're never truly going to know. We're going to be kind of a rookie in that field. So that's why when I grew, my practice and what I do, and then also my personal investing, I took this approach. And this approach is kind of a safety net that allows you to learn very quickly, because you're allowed to take those risks into new areas just based off of research that you've done online and talking to friends. It's all the experience you have. You feel like you have plenty of book experience, but you don't have real world experience. This is where investing with an asymmetrical return strategy really helps you, because once in a while, you're going to think you have an asymmetrical return strategy that can't lose, and you're going to find out that, wow, all I did was break even. Well, I'm sure glad that I went with that asymmetrical strategy, because I thought there's no way that I could lose, and my upside potential was huge. I wanted to put a lot more money into this, but I used this strategy because I knew that no matter how much money I put in, I was at least going to get my money back. And that's the downside risk of any asymmetrical return strategy should be, I get most of my money back, if not all my money back. Very simple one that I had come across last year is, I don't like buying property that's land only. That's really, for me, I don't have any experience with it. If it's a residential property or if it's a duplex, that type of thing, I understand it. I know where I'm going to get my growth from, how to analyze how much things cost in the area and what the turnover is. And when it came to buying a piece of land, I was just, that had nothing going for it. I could build on it, but it was super steep. I had no experience with putting in driveways and doing a new construction build, completely new, with a place that doesn't even have any permits. And we're talking about something that had a grade that was extremely crazy. Well, when it came to purchasing the property, though, I did my basic research that I always do. I looked around and looked through the MLS and found out what was selling, what was not. And then when it came to purchasing the property, I looked at what other properties in the area that were similar to this property were selling for. Now, some of this I'm getting experience from my residential side of investing, but getting back to this piece of property, it was very easy for me to make the decision to buy the property because I got the price down to 15 grand. Well, at a price of 15 grand, worst case scenario, I could have just, let it go for 15 grand easily. Like, there was neighboring properties that were better as far as the elevation and the grade, but they were wanting 80 grand for them. No house on them, but they did have some permits already issued. So I was thinking, worst case scenario, I could get rid of this for my money back. So even though I don't like buying pieces of property and I was going outside of my comfort zone in the real estate area, I I was able to buy the piece of property, and then the asymmetrical return was obviously there would be a huge upside if I could find a buyer, and I was able to do that. So for me, it worked out well. But worst case scenario, I would have been getting my money back at the bare minimum, but I still had on this piece of property. I sold it for $40,000, and I put a couple grand into it, putting a driveway in. So still, I went up huge on it, but I was doing something I was uncomfortable with. Even though I'm comfortable with real estate, I wasn't comfortable with this particular type of real estate purchase. But when you invest with asymmetrical return strategies, there's a lot of properties that I could probably make money on, maybe $5,000 or $10,000 that I've come across that were land purchases. But those weren't the investments that I could make because I was a rookie. So using an asymmetrical return strategy, though, allows me to jump into new markets that I normally couldn't get into. And that's what's going to make you a better investor, because you're going to have more options than other people. Now, this goes for things that you already know really well. Let's say something that you've done every day when it comes to buying stocks. Let's say you buy stocks and you have part of your portfolio you kind of do yourself and buy your own things. Well, you still want to take this and keep this in mind, in a very easy way, and this is way simplified, especially when it comes to stock investing. But if you look at a PE ratio as an example, and it looks decent, and you don't know the company very well, but historically PE ratios have been a good indicator of companies. So you look at that and it looks decent, and then you go to where the stock has traded. So the stock has traded from $10 to $20. Well, you don't know much about this stock. You don't know much about the company. You just kind of read a couple things real quick and looked at that quick financial glimpse on Yahoo Finance. And things are looking pretty good, like I said, with the P ratio and things. But you notice that the company, although in the last 52 weeks, it's traded from 10 to 20, it's now trading at, let's say, $10.50. Well, if the volatility has kind of been moving quite a bit, and you see that it's at the bottom of where it's moved in the last 52 months, and it's kind of gone up and down in that range over the last year, and you're at the lower end of that range, well, that's the type of thing where you could invest with sort of an asymmetrical return strategy. So if you didn't know anything about stocks, you could simply, just by doing a little bit of research online, you could still say, hey, this is worth me putting in a little toe in the water, and I don't know anything about it, but maybe I'll buy it for $500 or $1,000 and just see what happens. And if it gets on that upper side, since I don't know anything about stocks, I might go ahead and sell it once it gets over to closer to that $20 side. And that's a way that you can invest in stocks using an asymmetrical return strategy. Of course, anything that you do, you want to put more than just a couple minutes listening to a YouTube podcast before you invest in it. But that's investing with an asymmetrical return strategy, or a margin of safety. But let's jump down to that number 2 one that I discussed earlier, and that's don't be all in. This one is prevalent throughout investing and retirement investing primarily, which is so scary to me, because when I sit down with an individual and we're going over their snapshot of where they're invested right now, it usually looks like this. And this is going to sound crazy, but it's all, their whole retirement is in stocks and bonds or savings account. And that's it. This is crazy to me. Well, if you don't have any investment experience, you kind of listen to the marketeers out there and you end up in stocks and bonds, and I get that. But you're really all in on one strategy. And if it goes bust, your whole retirement goes bust. This isn't in like investing in your 30s and 40s where you're learning about different types of investments, buying and trading, and starting little operations in little moving companies or Yahoo or eBay companies or little things. I mean, this is like you're in your 60s and you have everything in the stock market. Essentially, bonds are not much more than other than your government bonds, but most of your bonds and your stocks are really kind of the same thing. They're really just securities. I mean, one is a performance-based security by the company, and the other one is a promise to pay by the company. But either way, it's just a security in a company. And most likely, if you're in a bond and stock market portfolio, you probably know very little about any of those companies because you own so many. And that's the problem with diversification is it's almost in a particular asset, you're over diversified, I like to call it disinformation. But diversification, is often used as a way to disinform people because there's no, if you had 10 stocks and a couple different bonds in your portfolio, well, you could research those and it would take you some time, but over 10 days, let's say, looking at one a day, you get a pretty good idea of what you're invested in. But when you're invested in 10 different mutual funds, and you take these and look at these mutual funds independently, and you notice that each mutual fund is invested in 50 to 100 different companies, well, it's going to be impossible for you to do any type of research. Now, if you can't do any research on an investment, because, you can do some, but it's a tiny sliver of what you're actually invested in overall. So it's not worth your time. And that's really where the disinformation comes in. So when someone starts talking about diversification and they're talking about doing it to the point where you're investing $100,000, but there's only, $50 invested in each company by the time you break it down, you're getting to a point where it's not worth your time to do research in that individual company. So then you end up not doing any research. And that's kind of the goal of the salesman or the broker. So, and I'm not bashing all brokers out there because this is just something they've been taught too. So I don't go along with the typical line of thinking in this area. So when it comes down to don't be all in, you don't want to have all your assets in one specific type of investment. You really should look at it for yourself. And if you need more help, you can listen to more of my podcasts about different types of investments you can get into or different areas to kind of give you a balance. But you really want to look at investing as kind of like being a table. Okay, now if you have a one-legged table and someone knocks a leg out, and I think you guys know where I'm going with this, the table's on the ground. If you have two legs, someone knocks a leg off, what happens? Well, you're still on the ground. Okay, you put three legs on this table, you knock a leg off. What happens? Still on the ground. Now you're starting to get the importance of not being all in because you need to get into multiple asset categories that are doing different types of things for you as far as investing goes because you need to get up to 5 legs at a minimum and hopefully get up even higher. And that's a pretty good analogy because you don't want to get overburdened where you have too much going on or too many things that are hard for you to understand or keep up with. So let's take, for example, we take that same table and let's throw 50 legs on it. Well, at this point, you're at overkill. Yeah, if someone knocks one leg out, it ain't going to hurt anything when it comes to the table as far as standing up, but at the same time, it's probably a little too much for any one person to handle. So, and that's with professionals involved as well. You still don't want to get that far out, especially when we're talking about legs of a table that are completely diversified and partially anti-diversified a little bit, where one where they're kind of the same thing, but they're a little bit different. Kind of like the example I was going over with real estate. If we're talking about a bare piece of land versus a duplex, well, yeah, they are different, but they're both in the real estate market. So when the real estate market as a whole slides a specific direction or has new laws passed in that ordinance or in that area, it may affect all of them in that specific area. So when we're talking about legs on a table, we're talking about things that are completely different. So we're talking about real estate that you hold. We're talking about precious metals, something totally different than real estate. And then we're talking about something totally different, stocks over here. And then we're talking about fixed income in another spot, maybe annuities or CDs or savings in another spot. Those are real easy and basic, and most of us have savings accounts. You already have one leg on your table, so before you get overwhelmed. So when it comes to that point, number 2, don't be all in. You're really looking at taking a close look at where your assets are, and go ahead and give yourself credit for having that asset of a savings at the bank. That's one leg on the table. And then just build from there. You're going to one new asset category. And a lot of people listen to this already have that one other one. So go ahead and give yourself 2 legs. You got your savings at the bank that you're keeping there. And you also have another one. What is it? Is it stocks or bonds? You have a little portfolio somewhere already started. So you got 2 legs on your table. And then now we need to develop that third one. Or maybe you already have a rental house, so you got that third one. Now we need to develop, that fourth one. Well, you really need to get to 5, 6, or 8 different spots. And then once you get, up to about 10, you're getting a little overwhelmed. So you kind of want to keep it in balance there. So we went over investing with an asymmetrical return strategy. We also went into not being all in. And so when you get wins from a particular spot, that's where we're going into our third one, and that's don't parlay all your wins. Now, once we start getting these different legs built on our table, so it's stronger and has a better foundation, and if something crazy comes along and takes a completely industry sideswipe, or the stock market drops 50%, it's not going to hurt us because we got more legs than just that one. So now what we need to do is, as we get wins in these particular investments, is we need to take some of those wins and spread them out to the other ones, or take and put them in what I call the keeper zone, or in a safer location or a different location. So most of your investment should be invested asymmetrically, but let's say you get a big win in that area. All of a sudden, that investment could become a huge part of your total portfolio. Quick example. Let's take somebody who, and for this example, I'm just going to use 4 investments. They have stocks, they have real estate, and they have a savings account. Okay, that's 3. And the 4th one is they own some Bitcoin. And it went from 10,000 up to 15,000. Or let's say they put it in way back when it was 5,000 per Bitcoin. Let's say they bought 1 Bitcoin for 5,000, and they bought some stocks for 5,000. I know real estate for 5,000 doesn't exist, but let's say they did that and they have 5,000 in their savings account. Now, when Bitcoin goes up to 15 or 20,000, now all of a sudden that one asset class has gone up so much that it dwarfs the other ones. Now, sticking to our table analogy, really what's happened is our other legs on our table are really short and we have one really long table leg. So we're not actually very stable when it comes to a foundation. And we're not taking money off of the winner and putting it into our keeper zone. Now, when we put it in our keeper zone, by moving some of that growth and putting it in some back into savings, some back into real estate, and some back into stocks, now we have a greater diversification because we truly have the same amount in each of those table legs balancing us out. Now, some of this stuff you've heard before, to kind of rebalance your portfolio is some things that people will say, but they're usually talking about just stocks versus bonds in your portfolio. But we're really talking about overall, including your savings, because when the stock market just tanks and nosedives, well, a lot of times you also have real estate tank and nosedive. And a lot of times you have other asset categories do the same thing, because overall, that's what a recession is. You will have hot spots in a recession that are still good, but if you don't have that basic savings, whether that's, and I don't mean just cash savings, but let's say you have some precious metals, you consider that your savings too. Well, you have something you can reach into that nobody else has. Everybody's down right now. Everybody's selling their car for, $8,000 and a $30,000 car. I mean, that they literally, just to pay off the loan on it, so they're going to lose it to the guy that's going to come collect their car for not making payments. I mean, they'd rather just make $1,000 off it and sell it to you so you can buy it for $9,000 or whatever. It's like you're going to have assets that come along that are going to just be unloaded. And that's where a guy with a savings account or cash equivalent comes out way far ahead. And I don't want to get too much into talking about the demise of the dollar or anything like that, but we all know that even currencies have some risk to them. So when we start investing, you're going to learn more and more about these things. And the thing you got to do is keep your mind open, and you also need to think about these three, because they're going to hold true no matter what happens. And I'm going to basically summarize those three back up. And if you guys have any questions, go ahead and ask them down below, and I'll try to make another podcast or YouTube video and address those, or just leave some comments. The first one is invest with an asymmetrical investment strategy or a margin of safety, or another way to put it is a not lose strategy. Number two is don't be all in, even when it is a great, hot, winning, trending up market. Don't be all in. Number three, don't parlay all your winnings. Take some of those winnings off your hot markets and put them in the keeper zone, and basically distribute them to other investments that you have and make your table stronger. Now, if you guys have those questions, go ahead and hit them below. Those are the three tips that I have for you when it comes to investing. And try to hit the like button if you can. Appreciate it. Take care.